Headlines are screaming about a G7 emergency announcement that supposedly sent oil crashing from $120 a barrel, trapping millions of traders on the wrong side of the market. But what if that oil crash never really happened? The real story isn't about a phantom price collapse, it's about why the mere threat of G7 action sent shockwaves through the markets. What does that violent reaction tell us about the hidden war between the West's paper promises and the East's ravenous demand for physical assets? The truth, as always, is in the numbers the mainstream media conveniently ignores. So, what really went down? Over the past week, geopolitical tensions reached a boiling point after a major disruption to shipping in the Strait of Hormuz, the channel for about a fifth of the world's oil. With tanker traffic nearly halted, Iraq was forced to cut its output by 70%, and Brent crude prices shot up, briefly touching over $119 a barrel. This wasn't just market noise, it was a genuine supply shock threatening to send global inflation into overdrive. In response, the G7 finance ministers and the International Energy Agency scrambled for an emergency meeting. The headlines that followed were explosive, with reports that they were considering an unprecedented release of 300 to 400 million barrels from the world's strategic petroleum reserves, SPRs. And what happened? The mere talk of this sent prices tumbling. Oil, which had been flirting with $120, pulled back sharply, with Brent settling in the $101 to $110 range. It wasn't a crash back to pre-crisis levels, but it was a brutal reversal. This demonstrated the immense power of government jawboning. But here's the detail everyone missed. It was all just talk. After the meeting, the G7 simply stated they were ready to take necessary measures, but stopped short of actually agreeing to release the reserves. They didn't fire a weapon, they just reminded the market that they had one. They tried to fight a physical supply crisis caused by a real-world shipping blockade, with the promised term of paper barrels. This reveals a dangerous fragility. When a system is this sensitive to rumors, it tells you the foundation itself is unstable. And this isn't even the main story. To see what's really happening, you have to look at silver. While the world was glued to the drama in oil, a far more significant battle was raging in the silver market. The price action has been violent, but this isn't just normal volatility. It's a symptom of a structural failure, a disconnect between the paper markets of the West and the tidal wave of physical demand from the East. For what is projected to be the sixth straight year, the silver market is in a structural deficit, meaning global demand is consistently outpacing supply. For years, this gap was filled by drawing down the massive inventories held in the COMEX vaults in New York and in London. But those stockpiles are now in free fall. The recent data is alarming. COMEX registered silver stocks, the specific metal available for delivery against a futures contract, have been plummeting. Declining inventories suggest that physical silver is leaving the vaults far faster than it's coming in, putting real pressure on the exchange as the ratio of paper claims to physical metal grows. This physical drain is driven by a massive shift in global demand. Industrial use in solar and electronics is one part of it, but the bigger story is the East versus West dynamic. A huge premium has emerged on the Shanghai Gold Exchange, with buyers in China willing to pay significantly more for physical silver than the paper price quoted in New York. This price gap acts like a vacuum, pulling real, physical metal out of Western vaults and shipping it to Asia, where buyers demand the actual asset, not a paper promise. Arbitrage, the force that should normally close this gap, is struggling because the available inventory in the West is simply too tight. The paper market is losing its grip on the physical world. This is a critical moment. The financial system is showing cracks that most people aren't seeing, and understanding the flow of physical metal has never been more important. If you want to stay ahead of this unfolding story and get the real data behind the headlines, make sure you subscribe to this channel and ring that notification bell. I break down these events every week, connecting the dots that the mainstream media ignores. So, how do these two stories, the G7's oil threat and silver's physical squeeze, actually connect? It's simple. There are two symptoms of the same terminal disease. The G7's emergency meeting wasn't a show of strength, it was a moment of panic. They were staring down a physical oil shortage, and their only response was to talk down the market with the threat of releasing paper barrels from finite reserves. They tried to fix a physical problem with a financial tool, and in doing so, they exposed the limits of their power. This act of desperation sends a powerful signal to investors everywhere. The system is fragile, and the people in charge are losing control. When governments have to resort to emergency threats just to manage commodity prices, it triggers a flight to safety, not to paper assets, but to real, tangible assets that can't be printed into existence. That's why the chaos in the oil market is pouring fuel on the fire already burning in the silver market. The G7's move, aimed at oil, created a tidal wave of uncertainty that is pushing smart money toward physical metal. The silver market is the canary in the coal mine for the entire Western financial system. For decades, The price of silver has been set by the massive volume of paper contracts traded on the COMEX, where paper claims on silver often dwarf the actual physical supply available for delivery. That system only holds up as long as everyone trusts the paper and does not ask for the metal all at once. That trust is now breaking. Geopolitical instability, like the crisis in the Strait of Hormuz, and the G7's panicked reaction are causing major players to lose faith in those paper promises and demand the real thing. They are calling the bluff. The oil market volatility is the trigger, but the silver squeeze is the main event. It's exposing the fundamental weakness of a financial system built on leverage and promises, a system that is now being called to account by the unforgiving reality of physical supply and demand. So, let's put it all together. The G7's emergency meeting didn't crash oil, but it did expose a terrifying crack in the global financial system. By threatening to fight a physical shortage with paper barrels, they revealed their own desperation and sped up a global flight to the safety of hard assets. The violent price action in silver isn't just random noise, it's the sound of a system breaking. This isn't a war between bulls and bears, it is a war between the paper promises of the West and the insatiable physical demand from the East. And the paper side is losing. Don't just watch the headline price of oil, that's the distraction. The numbers to watch now are the COMEX registered silver inventories and the silver premium on the Shanghai Exchange. As those inventories keep falling and that premium keeps rising, you are witnessing the real-time erosion of the paper financial system. The G7 may think they're managing an oil crisis, but they may have just thrown gasoline on the fire of a much larger monetary event. What do you think? Is this the beginning of the end for the paper market's control? Let me know in the comments below.